Okay, Happy New Year, everyone. This is Brian with NetPicks. Thanks for joining us today. And we have a jam-packed lineup of coaches to present to you today, our predictions and outlook on 2012. And so I think you're going to find a lot of good information in today's presentation. So sit back and relax and take it all in. And Mark, if you're on the line with me and want to say a quick hello.
Yes, thanks, Brian. Appreciate that. We're looking forward to doing this presentation. We did this last year. It was pretty popular. People enjoyed it. We gave the coaches an opportunity to kind of look into their crystal balls and tell us what they're expecting for the year. And we had a lot of people joining us live as well as watching it in the replay in the days and weeks that followed. So that's what we're going to be doing again. I think what we'll start out with is kind of give the audience a quick chance to make some of their own predictions. So I'm going to put some questions up on the board there, up on the screen anyway, and you guys can just click in and we'll sort of share the answers and see what we collectively think as a group. So the first one is just really simple. What do you think you're going to trade most in 2012? And that's Forex futures, stocks, and or options. I'm only giving you one opportunity to click something. I know some of you will obviously trade more than other areas, but we'll go ahead and have those options available for you. Okay, so let me get a few more people to click in, and then we'll send this out. And in this case, this is trade the most. We know that a lot of people will split and trade different things. You know, like I know personally I trade Forex and futures primarily. So you can see here we still have a lot of Forex trading going on, futures, and then you see the split on stock and options. Next one up is a prediction, if you can, for the U.S. stock market in 2012. Up 15% or more, up 5 to 15%, kind of unchanged, you know, 0 to 5%, maybe a little bit like 2011. Down up to 10%, or you're expecting a pretty good size down 10% or more on the year overall for the U.S. markets. And I won't ask any of the coaches who are joining me because obviously this may be part of their predictions that they'll be showing us here in a couple minutes. So we'll see what they have to say at that time. All right, so let's go ahead and share this with everybody. We've got, what, about 50% exactly are in the down crowd, and about 50% exactly are in the up crowd. And this is what makes predictions so difficult. It's kind of interesting that it's a dead split 50-50. Obviously, not many really optimistic people, 5%, and I would say definitely a lot more on the negative side because you've got you know, there's the 36%, 5 to 15, you know, kind of the marginal, or actually a little bit above marginal, pretty good, you know, up on the year. Next one would be just more on the euro crisis, which I guess depends on your perspective a little bit. You know, we hear about it a certain way here in the U.S., and I'm sure for my overseas outside of the U.S., you know, you have maybe a whole different perspective on it. So completely, but this will just be sort of an aggregate of an answer, whether you expect it to be resolved in 2012, at least by the end of the year. So yes, by the end of the 2012, more of an afterthought, or you know, no chance, and even more than likely potentially gets worse overall. Not too much of a surprise watching the results come in because we've got a bit of a negative slant here this year. So we've got about, what is it, 26%, yes, 74%, no chance. So Brian, I got a weird message. Or is my audio coming through okay?
I'm hearing you just fine, Mark.
Okay, and but you do see the polling results on your screen?
Yep, I see the results.
Okay, very weird. Okay, strange. Let's move on to the next one. This one is the potential crisis with Iran that obviously, you know, has the opportunity or the chance to worsen considerably. Will it make a dramatic impact, in particular, on crude oil futures or crude oil prices overall? I guess a lot depends upon whether you think that's going to ignite into something more than it already is. So more of the geopolitical effects overall. Okay, so we'll go ahead and share that real quick. Once again, I'm not surprised based upon the Euro crisis and the negative results expected in the U.S. that we're seeing that as a real potential problem in 2012. And really, last question for all of you is if you think you'll be doing style-wise in 2012, more day trading, more swing trading, or more position trading overall? And we have a fairly split group here, which is interesting. So we'll show that. We are like a 50-50 kind of crowd here. So about 50%, 52% more day trading, 46% a little more swing trading, and just a very small percentage doing a little bit more on the swing trade side overall. So appreciate you guys answering those questions. What we'll have to do is go back to these next year. Now that I think about it, we probably actually did ask some polling questions last year, and now I actually regret not actually looking at those to see how accurate we were or we were not. We probably should have even gone back and scorecarded our predictions as well, but maybe we'll do that another time. As you know, let's go ahead and get this started because we've got quite a few speakers. We're going to try to go quickly, not spend a lot of time on each of us, but we definitely have some different ideas to present to you overall, and there's the URL to our trading tips blog in case you ever want to hear more from the individual coaches that you'll be hearing from today. So the schedule is Troy Noonan's going to kick it off. Well, I'm going to kick it off with a few of my things, and then Troy's going to grab it and talk about the U.S. market, Euro, U.S. dollar, and crude. Shane, I'm not sure. He's been having internet issues, so he's up in Canada. If he's here, he'll be talking about major turns to grab a position trade, which has kind of been his focus of late. If not, we'll move on to Brian, who will talk about the metals, and then James over in the UK will talk about market behaviors, metrics, and other things that he's looking for in 2012. Coach Will is going to talk about crude and the Russell E-mini and his minimalist approach that he's really sort of made his kind of a mantra to trading and something that he follows very closely that I know a lot of you guys are interested in. Bob is going to talk about 2011, the volatile swings, and what he thinks is how that's going to impact 2012, and Ron's going to end it with swing trading, Forex, and oil, and probably get back to that Iranian crisis overall. Here's a bit of the NetPicks Yearbook. So a lot of you know some of the faces here. Obviously, top left is me. Below me is Brian. Below Brian is Will. Shane is in the top middle. Then Mike Ritchie, who's not able to join us today. Bottom middle, I guess, would be Troy. And then on the right, you've got Ron. And then below Ron, you've got Bob. So you'll be hearing from a good cross-section of us today. So I'm going to start it off and talk about a few things. I'm not the best prognosticator at all. For me, I'm more of the 2/3, 1/3 kind of person. That's how I like my trading systems to be. That's how I like my sports teams to perform, though they rarely do. UCLA Bruins, New York Jets. I'm speaking to you. But for me, trying to predict the market I'm probably worse than 50-50. You could probably have a coin that would be smarter than me when it comes to really making those big macro decisions. It's why I've always been such a believer in trading the way that I do and stacking the odds in my favor and being very technical and not really having to try to figure everything out. So what I thought I would do is I'd focus quickly on my forecast where I actually have some control for NetPicks in 2012 and kind of talk about a few things there so you guys kind of know where we're heading. The first thing is we're going to be doing fewer third-party offers in 2012, and you may be wondering what the heck is a third-party offer. And that's kind of when you get an email from us that maybe says, turn $10 into 10 million. Is that more than 10 million? That is a bizarre number that I'm missing a zero. But whatever that is, it's a lot of money in 10 seconds a day with the easy button trader. So to explain something about the way this business works, I want for all of you to understand is advertising in this field is kind of ridiculous because, as you know, brokers, I should say, they're really the ones that make the gobs of money. So they pretty much have this endless advertising budget, and they'll spend whatever money. So we compete in the advertising world against brokers who just seem to have an insatiable desire to spend anything to get an account. So what we end up having to do a lot, and over the years, is kind of work with some of our friendly competitors, and we do some cross promotions. And there's a place for that because if you're like me, I've always been looking at other products, services, strategies. I mean, none of us as traders are trading 100%. So there's always room for improvement. There's always things that we can learn about. You know, somebody else might have a system trading a specific market that I've never even considered before. It could be a good education. So we have always found there's definitely some complementary things. Unfortunately, what ends up happening is it's difficult for us to always know, is the product really going to live up to the promise? And I think earlier in 2011 in particular, there were some instances where we had some knowledge of a company or even the people behind the company, and we were like, you know, they don't really even trade. And that's a huge pet peeve for me. I just don't think you should be putting out products if you don't really trade. So we made a decision in the middle of 2011 to start to phase out as much as we could the third-party offers. And you guys probably have seen that. I think over the last 4 months, I don't think we've done a single one that hasn't been something from NetPicks and developed by NetPicks. There's been nothing. And right now on the calendar, we don't have anything scheduled that you're going to hear from us promoting another third-party offer. I won't say there'll be nothing in 2012. If we find something really complimentary that we think can help you, maybe we'll get a great deal from TradeStation or one of those brokers or something that really makes sense, you will hear from us. But we're really going to try to scale those back, let's say 90% or more from what you've experienced in the past. What that does mean is we're going to raise up or increase our product cycle in 2012 for partly that reason. In 2010, the only main product that we released was the SST. And in 2011, the only main product we released was the Keltner Bells. I mean, we did different things where we upgraded the SST. We added some new features. Sometimes we'll do some training or mentoring. We build things around the core products, but that really over the last 2 years has been the product releases. And we're going to see that increase a little bit in 2012, but what we're going to do a little differently is we're going to see a bit more of a niche approach, whereas the SST is the big, dynamic, powerful system. The Keltner Bells tries to be very dynamic, at least in Forex. We felt that we want to get a bit more focusing on specific niche type products. I mean, there's not a lot that we can think of that's going to replace, the SST and what that's doing, but we do feel there's opportunity in very specific areas that's going to appeal to some of you. It probably won't be products that appeal to all of you, like a scalp trading product. For some of you are like, heck no, I have no interest in that. That sounds like a lot of work, and I got to be there all the time. I'm a swing trader. But that's the whole idea. We want to have more of a niche approach. A pay for performance and profits only product, you only pay if it's profitable, you don't if it's not. A sector-based product, maybe something that's only focused on ETFs. It lives and breathes ETFs, or it lives and breathes the metals like gold and silver that Brian's going to talk about. And that's the whole focus of the entire product. Copy trading, which has to do obviously with it's the approach of the robot, but with human intervention, but actually having the ability to have your account copy what's happening in a master account. Product upgrades, enhancements, improvements. We're definitely going to keep focusing on that because we don't have a trade system that trades 100%. There's always room for improvement. You know that everything we always look at is always evolving. And we've got some other really cool things that we're looking forward to getting out there. So you'll hear from us on a regular basis, probably no more than you have ever before, but it's going to be much more specific to NetPicks and sort of the sphere of NetPicks rather than NetPicks interlaced with a whole bunch of other third-party stuff, which I'm sure your email box is already crammed with at this point. For me, a personal focus on the year is going to be what I think is a huge dilemma, and that's a lot of people are seeing success on their chart. They're not seeing success in their live account. So I kind of call it the paper profits looks good, but then for some reason you're having trouble converting what's happening on your chart to your live account. And this really is my focus this year, to figure out just what the heck is causing that problem for a lot of you. Because if you can get it right on paper and on the chart, in theory, right, we should be able to get it right in the account, and it just has not always translating for everybody. We talk to a lot of people, and a lot of people doing very well. And then we talk to people who are like, I just don't get it. I mean, things seem right. I know what I'm doing, but I'm not getting my account as profitable as it should be or profitable at all. Something is breaking down, whether it's mistakes, speed issues, the strategies are too complicated, it's a psychological barrier, you're overanalyzing everything, or maybe there's too much going on at once, you're over trading, maybe lack of automation, or there's too much analysis that has to happen at the point of trade. Whatever the case may be, we've got to find solutions for this in 2012, because it doesn't help any of us to have a great system if it's not being reflected, right, in the trade account. I mean, that's always going to be pivotal overall. Now I'm going to end it with a few of my, what I'll call my cracked crystal ball predictions, because I'll probably be no better than 50-50 on any of this. So I'm going to play it a bit safe, but I'm going to say, number one, I really do think that swing trading is going to continue to grow. We have seen this over the last couple of years. I think buy and hold is a waste of time. It doesn't work. It hasn't worked for a decade. So I think we know that part's broken. Rapid day trading is very viable, but it is a lot of work. It's always going to be a fair amount of work unless we can look at automation or copy trading or things that can make day trading easier. But unfortunately, even copy trading and everything else in day trading is very risky because of slippage, latency, speed issues. It's still going to come back to probably more of a swing trade type approach. Forex trading, I think, is going to continue to grow like crazy, but more so outside the U.S. If you're in the U.S., you kind of understand what I'm saying here. The regulators have really done some things to try to protect us, unfortunately probably overstepped, and what it's meant is a lot of U.S. brokers are doing awful. You know, TradeStation recently swooped up interbank FX for like next to nothing because the decline of accounts at U.S. Forex brokers is amazing. What's been happening. The exact reverse is happening internationally. Most international traders have pulled out all their accounts out of the U.S. because we have ridiculous regulations. The terms just aren't good. It's so much more competitive to have your account somewhere else, and the protection you got in the U.S., it kind of doesn't overwhelm all the advantages trading elsewhere. Unfortunately, U.S. traders, we're not allowed typically now to open accounts internationally because the regulators here have pretty much made it clear to a number of countries that if they do, they're opening up themselves to a lot of problems. But I think this is going to crack some point this year. I really do feel that the regulations are going to be changed. It's going to make it more competitive for U.S. brokers again, or they're going to allow us to go back to the international markets. Otherwise, I think we're going to see this continue to grow globally, and U.S. traders are going to be at a disadvantage. I do think, and this is a positive, Forex brokers here in the U.S., which I think is neat, now have to tell you what percentage of their accounts were profitable each quarter. Now, profitable could be a penny. It probably even means unchanged if the account's dormant. I don't know exactly how the calculations are done. But the good news is there's been steady, if small, improvement quarter to quarter. And in Q4, the top two brokers saw about 39% of their accounts were profitable. Granted, 61% were not, but that's no surprise. I actually think this is going to continue to improve throughout the end of 2012. I think there's just better systems out there, better training. I think people are getting to realize Forex is not the lottery. It's not get rich quick. And I think that's going to help improve things. I also think a lot of U.S. traders are going to migrate towards Forex futures instead of the straight spot currency for the reasons we mentioned. My last two quick things, I expect crude oil futures to hit 150 or higher. I'm curious to see what Ron's going to say about that later. And I actually am more of an optimist. I think this U.S. stock market is going to be up 10% or more on the year. So with that said, TJ, I'm going to hand it off to you, and you're next. There you go.
All right, cool. Thanks, Mark. You guys hear me okay?
Yeah, you're coming through good.
All right, let me just get my screen up. All right, cool. All right, so before I begin, I just want to show you a couple charts here, and maybe if you guys can type into the chat window some guesses on what you think we're looking at. That's a pretty ugly looking chart, wouldn't you say? I wouldn't want to be trading it. I don't know about you, but that's not the kind of chart you want to see when you're trying to find something to trade. So gold today, yeah, I didn't look at that, but it could be. I'll let you know in a moment. Type in your guesses. I'm going to show you a couple more. Okay, here's another one.
Okay, that was the Russell. No, I'm kidding. I'm just reflecting my trades today.
Okay. Well, if you have any guesses, maybe put in the number and then the guess. So chart 1, guess, chart 2, and then this one, chart 3. I'm just going to show you these 3 charts, and then I'll tell you what they are in a moment. All 3 look totally different, don't they? Let's just take another look really quick.
I had some people, just so you know, one person said Iraqi dinar, another person said my equity count, somebody else was research in motion, the weekly S&P, gold, etc. So those were some of the guesses.
All right, interesting guesses. Wow, quite a diverse range. So, and 3 totally different looking charts, wouldn't you agree? Okay, so now we'll come back to that in a moment. First, I just kind of want to recap some of the major news events. Just really quickly, let's just look at 2011. We already know about the Arab Spring, of course, and naturally the Euro fiasco that's going on right now. But look at some of the other things you may have forgotten about. The Japanese disaster, death of bin Laden, droughts in Africa, a terrorism attack in Norway. How about all that violent unrest in London? That was pretty wild. And then, of course, I thought the contrast of putting the royal wedding right after that would be kind of interesting. The Occupy movement, of course, the big Strauss-Kahn sex scandal affecting the IMF. How about leadership change in North Korea? That's a biggie. Needless to say, the ongoing Iranian tensions, the Iraqi war came to an end, so they say. MF Global, Steve Jobs died. And how about poor Amy Whitehouse? I didn't put her on there, but that was kind of a shock. And then, of course, the phone hacking scandal in London. And how about market correlation? I mean, wasn't it kind of hard to make any money parking your money anywhere in 2011? Seemed like all the markets just kind of moved lockstep, like they were all dance partners with each other. So there was really nowhere to put your money. I mean, we're kind of seeing a little bit of an uncoupling right now, or at least so it seems. We'll have to wait and see if that actually holds up. So, you know, a little refresher on 2011 helps you think about maybe what's coming up in 2012. The immediate past sometimes predicts the immediate future. So let's go back to chart number 1. Some of you were close with the S&P. That was the U.S. stock market, guys. That was a major part of the U.S. stock market. That was the NASDAQ on a weekly chart. You can see 2011, 2012, looking like it's testing the upper end of its range right now. But what we saw, it started out with this real interesting potential breakout move. Actually, it started dipping down, but then it went up. Usually when you have a head fake to one side, you expect the move to the upside to actually continue, but we ended up with that ugly expanding range kind of formation like we see in some day trade charts. Always scary to be mixed up in that because you never know when it's coming until after it's happened. And then, you know, you got this little flag kind of, here, I'll just show you, I already drew the lines right here. This looked like it was supposed to, you know, kind of like a bearish consolidation. It was going to break lower, and then the market zoomed up, and just a real mess, indicating so much uncertainty in the world and volatility. But if you think about it, there was some great day trading and short-term swing trading opportunities inside of these bars. But when you look at the big picture, it really tells a story, because you look back at the news events, look at the chart, and this reflects all the stuff that happened, all these crazy events. And so I'll just tell you, one of my predictions for 2012 is that it's going to continue. I believe the stock market's going to go higher. I believe we're going to have a lot more volatility. It's an election year. Let's go to the second chart, though. The Euro-US. Look at where it started. Look at where it finished. I mean, talk about buy and hold, huh, Mark? I mean, it got you nowhere. So here's a picture of that if you were just, of course, buying the Euro-US, obviously. But interesting how it just kind of went nowhere. Went up, went down. This was a nice tradable market, though. The Euro-US with the 5-minute using our SST plan in the trade room was spectacular in 2011, and I predict it's going to be spectacular in 2012 as well. And then the final chart is crude oil. But look at where it started and look at where it finished. It's pretty interesting, isn't it? So we had some great trading in crude oil. Crude oil is going to continue to be a great day trade. That's an easy prediction to make. We've seen it now for, well, I've been, you know, actively involved with it for close to 2 years with the SST. I've got great confidence that we're going to continue to see more of the same. other highlights for me and for us in the live trade room anyway, we did over 450 points with the Russell in 2010. We broke 500 points in 2011, and I predict we're going to have another 500-point run in 2012 using the exact same trade plan, not changing a single thing. I also think that you got to be very focused. I don't think you want to change very much. If you've got something that's working, double check it. If it ain't broke, you probably don't need to fix it. Stay with what's working. And if what you're doing isn't working, maybe you need to simplify things and just look at what is working. Look at what some of us are doing that's working and maybe start from there. There's a lot of other opportunities. The SST Pro is opening up a whole new world, obviously, of possibilities. A lot of members are starting to contribute trade plans, and I predict we're going to get a lot more of that this year. There's a lot of excitement, and I think we're all going to benefit as a membership by a lot of the member contributions, maybe more so in 2012 than we've seen in the past, and I'm looking forward to that. As far as my big off-the-wall predictions, I believe that Mel Brooks is going to influence the Mayan calendar, and they're going to discover some little artifact that actually should have had a couple more zeros in the date, just like the 10 Commandments was once 15 Commandments. Per Mel Brooks, I believe that the Mayan calendar will be the biggest non-event to ever grace our psyches. And I also believe that the U.S. dollar is going to continue to lose value against the Mexican peso. And that's it. That's what I got, guys. So I could probably talk more about this, but we've got a lot of people, and I don't want to steal anyone's thunder, so I'm going to pass it back to you, Mark.
Thank you, TJ. I have not analyzed at all the U.S. dollar against the peso. I feel so inadequate. I didn't realize you were spending so much of your time focusing on that.
Yeah, well, I have to keep my I got to look at the price of tortillas because I love Mexican food.
Yeah, so. You're looking at the big picture. That reassures all of us. We appreciate that. So let me go ahead and move on to, and thanks for that, TJ. I do appreciate that. I think the one thing there that's pretty obvious, too, is that with all that big movement in the euro, crude, the stock market, during the year, they ended up going nowhere. But like you mentioned, there is always a lot of opportunity, regardless, ultimately, of where we end up at the end of 2012, which is always reassuring anyway. So, Brian, I think we're going to go with you next. I don't think Shane's been able to resolve his computer issues yet, so let me hand it off to you, and you can project away.
All right, well, I'm going to apologize up front. I don't really have any humor built into my presentation, so I'll just throw that caveat out right away. Let me get my screen up and going.
Brian, those of us who know you well, you would never actually have to apologize for that.
Well, that's true, but some people don't know me, so that was pretty hilarious there, TJ. The Mexican peso. I wish I was that witty. All right, so you see my screen?
Yeah, you see the slide going up to the slideshow.
Cool.
There it is, gold and silver.
Very good.
Doesn't look very funny to me.
I was telling you, that's why I warned.
All right.
All right, here we go. One of my favorite markets to trade is gold and silver. It's a market that I'm involved in each and every day. And over the years, I've had the opportunity to invest in gold and silver in a number of ways, the physical and in options, the ETFs, and primarily now I trade the futures. So you name it, I've pretty much had the involvement of trading these two metals in some form or fashion. So what I wanted to do was start out and kind of recap 2011 and then kind of go over my prediction that I made in this webinar last year and see where it came in at. So first of all, gold started the year at a spot price of $14.32, and by September 16th, it was up to a high for the year at $19.23. That's a 34% increase. So pretty nice move, and I know a lot of the gold bugs at that point were thinking, oh, here comes 2000, we're going to break it and sail on to 5,000. There's a lot of dire predictions that gold is going to 5,000. It may at some point, but 2011, it wasn't in the cards there. So a pretty sharp pullback from 1923 and ended up the year at 1567. So on the year, gold was up 10%. That continues the 11-year run, an increase each year in gold, and so pretty impressive. And if we go back in time, my prediction last year in this webinar was that gold was going to be up 200 on the year. I was close, but not quite there, and it was about $150, $160 increase on the year.
That's a good prediction,
So,
though.
yeah, it's not bad.
Yeah,
My
that is really good.
my silver didn't quite pan out, but so we'll move to that next.
That's a joke right there. It didn't quite pan out. You get it? Sorry.
Thanks for identifying the joke.
Sure. Just trying to help you.
Silver started the year at a spot price of 31.16, and by April 25th, we had reached a high of 50.02, a high not reached since the 80s. And monetarily, it's the same price that we reached in the 80s, but value-wise, still well below the inflated U.S. dollar. But there was definitely a psychological bear at that 50 level, as silver pulled back very sharply from that level. I remember trading at around that time, and the markets were definitely moving each day, big swings both ways. So silver ends the year at 27.91. That's an 11% decrease. And my prediction last year was that silver was going to be up from the level on the year, and obviously I missed that one pretty big. And so that just goes to show you that bottom line is none of us know where price is going to head. And so I've got a solution for that in a moment. Here's a quick chart on gold that shows you the movement over the last 10 years. Pretty steady equity curve. There's bumps in here. Here's that peak at 19, a little above 1900, and then a pretty sharp pullback, but building a base here. And my opinion is gold's going to head higher, and I'll give you my prediction here in just a moment. So for those of you that are interested, I'll just give you a few of the highlights of how I trade gold and silver futures. I'm not going to give you every little detail, but if it's something you want to take with your methodology and potentially look at, then you can definitely do that. I start trading at 8 a.m. Eastern Standard Time. I end at 10 a.m. Eastern Standard Time, so it's a block of time that I trade. Power of quitting 1. In other words, if I get my first trade out of the chute is a winner, I'm done for the day. If my first trade, my second trade is if my first trade's a loser, second trade winner, I will take a third trade to try to get positive on the session. So that's what we call power of quitting here at NetPicks. And one other thing I want to throw out there is you want to be careful. The metals open up the pit at 8:20, and a lot of times you're going to see very choppy price action around that time as orders flood the market, and who knows what direction those orders are going to go. A lot of times you can get, if you have an open order out there, you might get snookered into a trade and stopped out very quickly. You might want to consider stepping aside for like 1 minute if you're not in a trade at that pit open time. So again, be careful around that time. And the one thing that I want to really kind of stress is that any system you have that you approach the market with should have dynamic stops and targets. And it's one of the things we preach here at NetPicks. Every system that we have just about has that mechanism built into it. The average true range on silver back on 5/12 when silver hit that that high of 50 was $3.73. Yeah, and today, in January of 2012, it's trading at 95 cents. That's a pretty big swing. And so the point I want to make there is you can't trade fixed targets and be successful with that diverging range. And you really need to have a mechanism of either stretching out those targets when the ATR gets big, or when the range gets big, or compressing when the market gets small, as we've seen here in January. One other caveat I want to throw out there on the silver futures is it's not for beginners. It's for intermediate traders to advanced traders. You're looking at a $25 per penny move, and so that can be, you want to make sure you have everything in a line, your trade psychology, the method you're using, That all has to line up. So it's not, again, a beginning market. And roughly you need a $25,000 account to trade that. So let's move on to a few things that I want to throw out there and my predictions for 2012 in the metals. One thing that you're starting to hear about in the news is the Fed going to implement QE3, Quantitative Easing 3? For those of you that aren't aware of what that is, I'll give you a brief definition, but obviously if you want to know more, just Google the term either QE3 or Quantitative Easing 3. So basically this is a time period when the Fed will start pumping money, quote unquote, into the system. They will be buying back our U.S. bonds, the bonds that no one else wants to buy, that China has said we're not going to buy anymore. So basically what happens in that process is the dollar devalues, and what happens to gold and silver and a lot of the other commodities in that scenario? They go up, okay? So here's a few of the headlines from, I mean, you can find them all over the place, from MSN, from Forbes, that started to talk about the potential of QE3. My opinion, if I have to make a prediction here, is that at some point in 2012 we will see QE3. That's my prediction. And so we'll see if that comes to pass. Let me talk a little bit about what happens when that process engages in the market. This is the silver chart from 2010. And right here where we get the hints, the news, starting to look at the possibility of QE3, the market here started to head extremely strong to the upside. That's a strong uptrend to the upside here. Then finally on November 3rd of 2010, QE2 was now announced. And I remember this day. I was actually trading options this whole way up here. And I remember that day when they announced QE2, the market reacted to the downside. I remember thinking, oh, here we go. It's, the news is out. It's going to, at this point, turn down. But look what happened. I mean, we had a strong move to the upside for the rest of the year. So what I want to point out there is if we get closer and you start to hear more about QE3 or some kind of quantitative easing, then you might want to consider playing some options on gold and silver, as they probably, the markets in that time will probably pick up and become more active. The good news for the futures traders in this market is if that happens, I can almost guarantee you the markets are going to pick up and perform very well for us also. So here comes the prediction part of my presentation. I'm going to say that gold's going to end at 1900 for the year, and I think it has a very good possibility of breaking 2000, heading above 2000 at some point, but then we'll pull back. And I'm going to expect the same thing for silver. I think silver could potentially go up and touch, break 50, and then probably settle back below at some place. So I'm going to predict 45 on the year. So that's pretty much my quick presentation on gold and silver for 2012.
Great, thanks, Brian. That's good stuff. Appreciate that as always. So we're going to go ahead and move on to James Kessick, who is joining us from the UK, and he's got kind of a funny accent, but he probably thinks we have a funny accent too. So I'm going to project your slide here. So let's get that going, and then we can get started. Okay. Hopefully this will work. My computer's a little bit of a drag right now. So you tell me when you see it on your screen, James, and you can kick it off. It's
okay. It's there, but it's not actually started the slideshow yet.
Yeah, it's kind of unfortunately dragging for some reason. Anytime you're ready.
And you just made a funny, Mark. Mark,
I
you
did?
just made a funny. You just said it was dragging. What's on the screen?
That's pretty good.
Yeah. What a comedian.
I don't even know when I'm being funny. I'm that good. Of course, it's really not funny when I can't get James's slideshow to start here. Okay, come on. There we go. Is that working?
That's working now.
All right. Phew. That's a relief.
Okay. Well, anyway. Hi, everyone. So we're told that this is going to be the year of the black water dragon, and it's meant to be a year for big ideas and projects, and success will come to those with dealing in finances, well, that's all very well and good. But what I know is that there's no guarantees. Knowing what the market is going to do doesn't mean a thing. So rather than making wild predictions, I'm going to talk briefly about trading reviews and target planning to move your trading forward. Okay, so to start with, any business needs to be able to gauge its own performance, broader market conditions and the targets for the coming year. An individual trader needs to do exactly the same thing. So I'd like to share with you just a broad review and preview structure that you can go away and do your own each year. So what I'll be looking at is what's going on in the prior year. Have there been any particular economic and political themes? How the market has been performing and behaving from a technical perspective. If there have been any particular leading markets, I want to look at my own personal trading metrics. Then I want to have a look at the previous year accuracy of my own preview and whether I've accomplished my own targets. Then, of course, we move on to making projections and targets for the following year. So, 2011, what happened? Well, there was QE2 being, the economic recovery was meant to be happening, there were meant to be more jobs, but according to the BLS, unemployment for December 2010 and 2011 were 9.4 at 8.5%, and then the yearly average unemployment was for 2010 and 2011 were 9.6 and 8.9% respectively. So, you know, things didn't really work out from the employment perspective, and the housing market remained subdued and lending wasn't exactly free-flowing. But did this mean that QE2 had failed? Well, I don't think so. I think that there are, because of the European issues and global uncertainties, there was probably a lot weighing on the markets as a whole. And the money maybe didn't get quite to where it was meant to, the SMEs and the people of the United States. From a currency and commodities perspective, we've touched on this already. With the QE program, the idea that QE3 might happen, there was more of the dollar about. Commodities, generally speaking, will go up if they're priced in a weakening currency because they hold intrinsic value. Plus, of course, the other thing is that they will vary with economic prospects. So, as a rule of thumb, for example, when the economy looks like it's going to do well, the expectation is that oil should go up with greater economic productivity, and gold might go down because people want to put their money to better use and make some better profits. So again, the European sovereign debt thing was a real problem, which basically just won't go away right now. And of course, with all these different things going on, there was a lot of volatility. And I think the thing to really learn from 2011 is that markets can change very, very quickly and dynamically. And then, of course, right at the end, punch in the gut, to many, was the collapse of MF Global. And you know, a lot of traders got caught out by that, and I'm sure investors did too. So moving on to 2012. What are the prospects of QE3? Well, I think that there are good prospects for QE3. I think it's quite likely. But will they try and do something slightly different? I think they might do something slightly different, but it will be mostly in line with what's happened already. Oh. And then, of course, then the US elections are going to be a big thing. Global political tensions. Iran recently has been escalating the problems. There's going to be oil import embargoes in Europe on Iranian oil. And then, of course, the European sovereign debt issue is still a problem. And this is leading many to speculate whether the euro as a currency is going to actually be in existence much longer. I don't think that's necessarily going to happen. I think that the implications are far too great. But something does need to change, and the ECB's mandate, which currently is just for price stability, needs to change. The real issue is, though, that changes like this in Europe, with all the different nations involved, can take quite a lot of time. Following on from this, any other big companies to fall? Well, I don't know. I mean, there was always this talk of Dexia and big banks in Europe that might have got sovereign debt exposure, and if there was a big write-down, well, what would happen there, and then what's the counterparty risk, and so on and so forth. There could be big problems there, but we'll just have to see and have plans for if that does happen. So my prediction is for possible market behavior, and this is possible, is that the stock market is probably going to be broadly flat to higher, as we currently are, in anticipation of a QE program. When the Fed clearly indicates its intentions, I think the market will do as it did before, and it will go up. This is the stock market. But no matter what happens with the QE program, I think that when it's finished, if Europe hasn't been resolved, you could see volatile conditions again. And I think currencies are going to have a big part to play again in 2012. So finally, I'll be moving on to my personal review without breaking it down too much. 2011, my market expectations were broadly in line with what happened. Obviously, there are various unpredictable things in there, but the dollar was always going to play a big part in my mind, and it did. I was happy with my trading performance, and my trading targets were met. And more importantly, my plan was adhered to well, so that was the most important thing for me. With trading metric point of view, I mean, we can talk about this in a later stage, but just things like the average day and the level of consistency, and you can talk about metrics for identifying those particular figures for your own trading. And my 2012 targets for myself, well, it's going to be broadly the same for the markets that I trade, which are generally the E-minis. But what I do want to do is, as Mark mentioned before, is expand more into swing trading and possibly add some different markets for my day trading. Looking at possibly the treasuries I used to trade, and I feel they offer some great opportunities. You know, they're affected by interest rate changes, and whilst that might not happen immediately, it probably isn't too far along the horizon. Of course, they open at 8:20, so they're open for the 8:30 economic releases, and then they're affected by global events, quantitative easing, and of course you can spread them quite well because they're interrelated, so you can trade the note against the bond, etc. And the last objective for me is to really target the times that I actually trade. I'd say one of the things that I've definitely noticed this year is the dead time created by trading in the middle of the day and and the time that really is less busy, there's less volume, less movement, and you kind of get stuck in a position. So really I want to focus my trading on the busier parts of the day, the beginning and the end of trading sessions. So finally, moving on to the last slide.
I'm trying to. Trust me. Just keep talking, and hopefully it'll switch.
Listen, as much as I believe
Is that the last slide?
it is.
Okay.
As much as I believe in identifying market behavior, I know that we can never truly know what will happen. Our jobs as traders is to identify mispricings in instruments and trade when we feel the opportunity outweighs the risk. Whether or not you have the ability to predict the future, what really pays is hard work. So listen, plan, and trade. Thank you.
Thanks, James. Appreciate that. It's always, I think, beneficial. You know, we're here in the U.S. and most of the coaching team is here in the U.S., so we have a certain perspective on what's happening, and it's always nice when we can hear from somebody outside, right? The borders.
Right.
You know, that's why it's nice to hear from Shane a lot as well. You know, it's just Canada, right? But still, it's a very different perspective potentially than we have. So definitely appreciate that. So with that, let me move on to, I gotta see who I'm moving on to here. So we're gonna move on to Will. So Will, I'm gonna hand it off to you and get you going. So there you go.
Okay, thank you, Mark. Oh, there we go. Show my screen. Yes. Screen of monitor 2. All right. Hopefully. Oh, there you go. Not what I wanted to show, but there you go. So just to talk about what I said last year, I was really expecting last year that the markets were going to be breaking out from the consolidation we'd seen the previous couple of years, really, and that didn't happen. So big failure on that prediction. And I talked about continuing to use the minimalist approach to trading and also diversifying into more stock swing trading using options, which I did not do. Just got distracted with other things and never really put my plans in place. And you know you shouldn't trade if you don't have a plan, right? All right, so for 2012, I thought I'd actually try and make a scientific prediction of where my favorite markets were going to go. And for me, those are crude oil and the Russell. I swing trade the Forex, but my heart is really with the futures, those two in particular. So for this task, I decided to use all of the tools available to me as a trader to help come up with an accurate prediction of what was going to happen next year. And, you know, we all have these tools at our disposal. It's how we use them that makes the difference. So here goes. For the Russell E-mini, the one thing that you'll notice when we look at the chart in a moment is that the rally that started back in 2009 after that huge drop at the end of 2008 is weakening. And we're facing some really strong resistance up around the 900 level, a little bit below that, which we're having a hard time breaking through. The rallies we've experienced, they're really weakening when you look at volumes, whereas the declines that we've seen have been strengthening. So here we have on the top, that's a monthly chart of the Russell, and on the bottom down here, that's a weekly chart. And I want to call your attention, when you see something like this, actually, let me go to the trade station so we can look at the full chart. All right. This, by the way, is the Russell since 2002. So you'll notice I was talking about that strong resistance at below 900. That's up here. And we did have an attempt earlier this year to break through it. We broke through this previous high briefly, but then immediately took a dive again. So what I wanted to point out is, look at these things. Look at, this is a nice big breakout bar. We took out this previous swing high that we had in the Russell back in 2010. But compare the volumes. The volume on this breakout is truly anemic. I mean, there's no strength behind it. Compare it to the volume back then, and you'll see that it's actually significantly lower. So we have been moving up. And, you know, volume isn't always the best indicator. Actually, if you look down here, this is back in 2009 when we had that recovery from the bottom. We had a very nice uptrend going, but it was on rather anemic volume, and volume kept weakening as price moved up. Then you look at the strength of the declines. And here we're taking out a couple of minor swing levels over here. We didn't quite break this swing level, but the volume was truly astronomical, so a lot more strength on the moves down than we have seen on the moves up. And here we are bouncing back up. We're going to take another shot at breaking this high. You know, we're still under 900, but look at volume. Look at what it's doing, especially on the bars on the months that ended higher. Now this last one is January, and we still have a week to go, but you can already see for the 3 weeks so far, anemic doesn't begin to describe this market. This is moribund. So going back to the chart over here, on the weekly, and this essentially encompasses all of last year, we have the same phenomenon. We have some higher highs that we're setting, but this most recent weekly high, which took out this earlier swing from back in October, volume is pathetic. So what I'm seeing for the Russell is I'm really going against what I think is the majority of opinion here, but I'm seeing a decline coming again for us. And I think this will be a fairly major decline. We're not seeing any force in the moves up, and we're seeing a lot of strength, a lot of force in the moves down. So my prediction is we're going to see a 15 to 20% decline in the Russell. I think we will be testing this level over here from back in early 2009. And that's my prediction, and I'll stick to it. Crude oil, similar situation. We've been consolidating since 2009. It's really a coiled spring. I expect a breakout. I'm not positive in which direction this breakout will happen, but I do notice on crude oil the same thing we saw on the Russell, that the rallies are weakening and the declines are strengthening. So here you see a good example where we had this swing high earlier. This was back near the beginning of last year. And we took out that swing high, but you'll notice the volume compared to the volume back here, much, much lower. And then on this swing low we just created where we took out this earlier low, the volume was also higher, not much higher. This had been a pretty powerful bar, but it had been higher. And yes, we've continued to climb a little bit, bouncing back, but again, pretty anemic strength on the increases. This is on the monthly chart. We see essentially the same phenomenon on the weekly chart, and again, this is most of 2011. Also look at the OSOB indicator, which for us is, when we use our systems, it tends to be a confirming indicator. On the monthly, it's barely gone positive in the last couple of years. So a lot of weakness in this market. All things being equal, I expect that we're going to see a breakdown this year, a breakout this year. My chart reading tells me it's going to be to the downside, which would be a wonderful thing because I need to fill my gas tank later this week. But we'll see how it ends up. There are, of course, all the caveats. And the caveats are the big ones, global events. We've already talked about Europe, Iran, you know, what happens with the price of oil is going to have more to do with what happens with Iran than it does with what we see on the chart, quite frankly. China, which has been an engine for global growth, is slowing down in its growth, so what's that going to do to us? The presidential elections, I've looked at enough charts around political events to know that they can wreak havoc with any kind of analysis that you make. Rumors fly, accusations fly, numbers get thrown around, and anything can happen. And finally, Murphy's Law, something is going to happen that we haven't even considered, and it's going to move the markets in unexpected levels. So those are my predictions. I expect the markets to decline on the Russell and on crude oil by approximately 20% for the next year, but I could well be wrong. Because I don't rely on these long-term predictions as to what I do with my trading, I really don't care. So I'll tell you what I'm going to do as a trader. My trading plan for this year is the same it has been. I focus on day trading. That's my big thing. I love day trading. I'm not too keen on swing trading, although I do it. And I definitely don't position trade. My minimalist day trading plan I've gone over in several presentations, so I'm not going to go through the details, but essentially it focuses on trading during the best trading periods of the day. And that's a 30-minute window on crude. It's a different 30-minute window on the Russell, and a third 30-minute window on soybeans. It's a wonderful approach. It's very easy to trade, and the results are a lot more consistent. And for swing trading, I'm swing trading the UST. Essentially what you see in the UST Owners Club nightly update, that's what I trade. Why don't I trade the Keltner bells? Well, because I do the UST nightly update and I can only focus on one thing at a time. And finally, I'm just going to say, if you want to be successful, worry less about long-term predictions and focus on what you're doing day to day. Make sure you have a tested trading plan that you have confidence in. Maintain your focus and your discipline in executing and following your plan. So that's it. Thank you very much.
Thanks, Will. Appreciate that. I think a good point there is made that it's a lot of fun to make the predictions and see how they turn out. The good news is you, me, etc. We can be completely wrong and still have a good trading year. So this part is fun, but it doesn't impact obviously what we ultimately do as traders. So let me go ahead and hand this off now to Bob. You're up next. So Bob, here you go. And then just you grab the mic and go for it.
Okay. Let's see. I've grabbed the mic. I thought I grabbed the let's see. Are we seeing anything? Oh, I don't see anything. Hello?
We see a blue screen, just an empty
We see your
workspace.
background.
Yeah, that's all I see.
You probably
Right.
set it to the wrong monitor.
Oh, something happened.
You won't see anything on your monitor, Bob. As presenter, you don't see it. Okay, now we see your.
Okay.
There you go.
I'm sorry. There was a little momentary pause there. Is my screen up right now?
Yep.
Okay, great. Well, this has been really fun listening to the other coaches present because none of us have collaborated, and it's interesting to see where we agree and where we disagree, and where we mostly tend to agree. So a number of the items in my chart I'll probably just zip through quickly because very similar predictions. The first thing I did before looking and predicting or even considering 2012 was to look at 2011. And it's too bad Mike Rixey isn't here because we've talked about the 2011 market a lot lately because of the volatile market swings. We've seen big market swings up and down. It's been a very difficult market to swing trade, and Mike's experienced that as well as I have with some of our swing trades with options that we've been doing, particularly in the latter half of the year. The beginning of the year was a little easier, as you can see from the next chart that I'll show you. But basically, we've seen lots of frequent reversals, and the magnitude of these reversals have been quite large. This has provided a great opportunity for day trading. So the day trading side of our trade plans have actually done quite well. The swing trades that rely on trades to complete in a matter of days to a week or two have been less successful towards the end of the year because of these market swings. The other coaches have covered the uncertainty, the reason for this. It's an election year, the Eurozone debt crisis, our national debt we haven't really resolved yet. The housing market this past year, we saw housing pick up a little bit, but prices still down. GDP, again, it's been picking up a little bit, but we're still looking forward to a more healthy GDP growth. All of these things, all of these issues, and of course some of the issues that TJ brought up, some of the world events, all provided uncertainty. And this has created a 2011 that has seen great swings, great reversals. The next chart I have is a chart of the S&P 500 index, and this is generally regarded as the best single gauge of the U.S. large cap equities market. And this is what we saw for 2011. It started out just about exact. In fact, it ended within a couple of ticks exactly where it started out, which is really quite amazing. When you look at these swings, we saw right off the bat an increase of almost 7%, then a drop of 7%, a gain of 9%, a drop of 8%, up almost 8 again, down almost 19%, and then look what happened in the August-September timeframe. This provided a very interesting time for swing trading, which is the primary trading that I do. In the late summer, we saw swings up and down 10% just from week to week. And then towards the end of the year, November, December, pretty much stayed the same. I mean, right here when November started, it ended there in December, but we saw, again, large swings. There was never any clear direction for this market. We saw about 18 reversals lasting an average of about 13 trading days. 16 of these reversals were greater than 7%. And when you consider that a 10% move in the market is defined as a correction, we saw about 4 or 5 market corrections this year based on these swings. But looking at the overall trend of the market, it went absolutely nowhere. This next chart, let's see what's happened here. Here we go. Here are the actual prices for those swings that I put on the previous chart. And again, this provides a very interesting view of what happened. Notice the 2011 open, the very first tick on January 3rd. Look at the very last closing tick on 2011 December 30th. 1257.62, 1257.60. Unbelievable. It closed, it pinned right where it started. Yet looking at the average number of days, or number of days for each of these swings, it averaged about 19 calendar days and about 13 actual trading days. So very volatile market. And there are the gains that I showed on the previous chart for a net of 0. So again, very interesting market to trade this year, and we saw lots of swings and lots of reversals. And this made a very volatile market. I haven't really seen a market like this in a number of years. We've seen markets where it's gone up, it's gone down, we've seen some violent moves, but this back and forth with the magnitude and the number of reversals is really quite unusual. Picking up from where I left off in the last chart, this closing right here at the end of 2011, you can see we've been going pretty much straight up. And from the last swing low to where we are now, up 10%. Here's where I have to agree with Will. We are a bit overextended right now. And this is another 10% move in the market, but I like Will's chart showing the volume dropping off. I think that's exactly right on. I'm right now expecting a market turnaround, and you can see I think that last candle is actually today, maybe yesterday. But anyway, you can see the market is starting to turn around. Who knows, that may turn to be another reversal point. So what am I looking at for 2012? Again, it's fun to predict. I don't rely on predictions. I totally agree with Will. I trade the charts, but it's fun to take a look and prognosticate and see where we end up at the end of the year. Last year, if any of you were on this call, I made absolutely no predictions. I said I don't make predictions. I just trade the charts, and I hold that same same position this year. But I decided to throw an outlook out there since that's what makes it a little fun. I think it's more of the same. I think we're going to see volatile markets and big swings again. I don't see that anything has changed. Nothing is really different now than it was a year ago. It's been an election year for 2 years, so this is the second of 2 election years, and in the U.S. this election cycle seems to be going on forever. The Eurozone, the debt crisis did not get resolved. Middle East, continued unrest. National debt, we still haven't addressed it. Housing sales are up thanks to investors. Prices are down, and market predictors are expecting housing prices to continue to go down, although sales are going up because investors are stepping in, seeing some good deals. GDP is starting to turn around, so that's good. But again, I see more of the same. Echoing what Will said, I see stocks down for the near term, but I'll go on a limb and say that in the long term, meaning by the end of the year, they may be a little bit up. I think they're actually going to be up, and I say that for a couple of reasons. With the market not going anywhere for a whole year, there's been a lot of pent-up demand. Most of the U.S. corporations have they've laid off a number of people over the last 3 years, and that layoff cycle is kind of completed now, and they're operating lean and mean. The PE ratios are low. We're starting to see some health return in the economy, and a lot of investors and a lot of mutual funds have seen cash put on the sidelines. The cash has been going into bonds. That's why bonds have been driven way up. We've seen the long bond, up, or I should say down, with an interest rate of 3%. It can't sustain 3% in the long term. Those rates are going to have to eventually go up because the GDP is starting to pick up. Because we've been consolidating for 3 years. The money has gone to the safe investments, mostly U.S. Treasuries. But again, the discussion that James had on QE3, I thought was very interesting. If there's another QE3, another quantitative easing, the Fed's going to be buying more bonds. That again will, could drive interest rates down a little bit. But how much further down can they go? How much further up can bonds go in price? I just think that investors may be seeing the end of the run in bonds, and with the pent-up demand of stocks, I could see later in the year, possibly maybe even the beginning of 2013, a major shift from the bonds to the stocks. Again, it's just my prediction or thoughts. This may not happen right away, and again, I expect stocks probably to go down, at least in the short term, as Will's chart showed. My plan, don't rely on long-term trends. Don't rely on predictions. For me, I'm going to be continuing swing trading. For me, I find swing trading to be a little less, not a little less, but considerably less stressful than day trading. A little more time to place my trades and to consider the direction that I'm going in. But this year I'm going to be limiting picking the direction for most of my my trades because of the wild swings we've seen, because of the unpredictable nature and the quick turnarounds. I'm going to be a little more picky picking my swing trades. I want to be have great confidence. I think the SST provides a great system for providing that confidence. I'm using options more this year to supplement my swing trades with premium selling. Again, because that allows me to be wrong part of the time and still come out even or even with a little bit of profit with the premium selling. So if I'm placing a trade, I may sell a little premium outside the pricing. If I'm going long, I may sell a call outside the money. So that's my swing trading plan. Day trading, I really like Will's minimalist trader approach. I'm continuing with that. I'm going to stick with the most liquid futures and forex markets. Mostly the futures markets, though. And with forex, I tend to like the currency futures over the straight forex. I know that you can't trade. There's a little bit of difference, but I do like the regulated exchanges for that. I like limiting my markets and time frames. A couple of the other coaches brought this up as well. Trade only those markets and time frames that are liquid in a time frame where things move, and limit that to the hour or half hour or hour and a half, to just the amount of time where there's really the greatest opportunity for movement. That way you don't end up in that dead midday hour, as James mentioned. You don't want your time frame to extend into a period where we see little movement. So I like Will's minimalist approach when it comes to my day trading, limiting my markets and time frames, sticking mostly with the futures markets. And I believe, yep, that's my my thoughts for this year.
Great, thanks, Bob. Really do appreciate that. So let's go ahead and hand it off to our last predictor, our last psychic of the presentation, and that would be Ron. So Ron, I'll hand it off to you as well. Give you the mic and give you the projection, if that sounds good. So Ron, I see your screen. I don't hear you. I'm not sure if anybody else does.
Okay, sorry about that. I was saying, yeah, can you see my screen? But you couldn't hear me. So, good sound, good screen?
Yep.
All right, sounds good. Well, last year I made the prediction that oil will hit $100 a barrel, and obviously it did easily. This year, though, even though I was 100, one for one, I'm obviously going to show you a couple charts, and 104 is the next big level. So we're going to look at that. We're going to look at the euro, and I think it will break below 128. And but it's got some more room on the upside, so some good trading opportunities. And it was kind of interesting that we talk about a lot of the coaches are saying we're going to do some more swing trading. I think most of you all will probably start swing trading more. So that being said, let's go ahead and of course hopefully with us, because I think most of you all know we do what we say we do. We trade this every day, and so we know what works, and we're always out there looking and working hard for you. So here was last year's meeting, and obviously oil had flirted with and just broken that $100 level, but it obviously did pull back nicely. So then we kind of go into the year, and it kind of rolled on up and hit a high of about 16, 17. So if you take a look at this and you go from this low to this high, you've got some, obviously this was an unbelievable
Ron, I'm still seeing your PowerPoint. I'm not sure if you're showing something else.
Well, I mean, can you see, you should be able to see this chart. I just flipped to the next page.
I don't see it. Unless somebody else
That's odd.
seeing it. If you guys are, then
let me go back
good.
to the original. I just changed the page on the PowerPoint, so I changed the, I'm back on the original
No,
page.
it's stuck on the same.
All right, let me try.
Do you have the projector paused? It may be paused.
I don't think so. Let's see. Click, start sharing. Okay, how about that?
It's turned off now, the projection.
All right, this is. It shouldn't be paused.
Well, it's off now, actually. Okay, now it's back on. Now we see your chart. Now we see your mouse moving.
I'll let you all know when I flip to the next chart, and we can make sure that it does indeed update. I should have it going. So last year's meeting, this was basically where we made the prediction, and it did rally up hugely to about the 16, 17 level. Just kind of looking at taking some fibs, you basically were looking for a retracement back to this 50% level, about that 103.65, and believe it or not, that's where we're at right now. So, once you get past a 60-some-odd% retracement, then you're actually looking for a short side, and so you can see, you have great opportunities on the short side, and pretty much been looking for longs as of late. But that's where I say that 104 level, I think it's really going to go a lot higher. I think it's going to break 110, probably back up to 115, and then on up to 120. Mostly due to the situation over in the Middle East, and and I think the economies are starting to slowly do better. So therefore, we're going to see a little bit more price action on demand. But right now, it's a tough one to trade off a daily chart. So that's not something that I do. I don't trade oil off the daily chart. I trade off the 500 tick. I call the trades in the live swing trade room that we run, and they are incredibly accurate, really, really good trades. So let me change the chart and let me see if you guys can all see that.
Yeah, you're good.
Okay, great. So what I think is going to be the year of trends. We are going to see some nice trends. We're not going to have nearly as much up-down chop like we did in some of those charts you saw, but you need to look for retracements, okay? This indicator that we have, the directional, okay? We have it in almost every single package we have, the Keltner bells, the UST, I think even SST has it. But anyway, a very powerful indicator, and I'll show you how you can use it on these longer-term charts. And of course, fibs, really good for looking at some possible retracements levels that you can go. Look to longer-term charts, daily and even the 4-hour. That's what I do in the room each night. Is typically I've got some great 4-hour pairs, and I'll show you those. So here is my little survey. Day trading is fun, or day trading is stressful. So you can type that in. I'm sure everybody's got a stressful story. You sweat as soon as you get triggered into the trade. Maybe day trading isn't for you. Okay, so swing trading is relaxed, or I can't sleep at night with open positions. You have to, it's hard to be a swing trader if you can't sleep at night with open positions. So, go with proper risk management, and you should be able to sleep at night. So let's go ahead and take a look at some of the Forex charts. This is one I love in the room every night, the dollar Swissy. Okay, and this was back in November, and you can see these are some possible targets, and this thing just kind of rolled right on up. But what I wanted to show you was look at these pullbacks. This heavier line is our directional. And so if you happen to be out, let's say you pulled all your profit, look for these pullbacks to this directional. And again, look, rally right on up. Nice pullback. Kind of a little bit of a rally. Yeah, they're getting a little bit smaller, and a pullback, nice rally. So here, this was just earlier in the month. We had a pullback, but I said, look at this. We've had this kind of double, triple top, or actually it was a double at that point in time. So, I'm not going to take this unless it breaks it. And so we didn't. But currently, we're in a 4-hour short. This is the nice thing about swing trading is you only do 1 or 2 trades a month. And if you go longer, daily, weekly, monthly, you're just going to have a lot less trades. But those trades are big. So now, this is another one that I love, Aussie dollar. And obviously, one thing I think I mentioned at the end of this, watch out for correlation, just like gold, silver, oil. Don't go long on all 3 of those, all right? Because they're highly correlated, and if they start going against you, you could end up with 1, 2, 3 losses. So, pick the one that looks the best, or the one that you've obviously tested, and go long on just one of those. You don't need to be all in on one particular direction to make a lot of money. So again, here I'm going to show you, we talk about what you see is what you get, and so here I don't have any targets on here, but it looks very tradable. I'm sure you all would have said, oh, I would have gone long here, sold right at that top and got short, and I would have skipped all that, skipped it completely, but got a nice short and went long. Well, this is what our indicators do, and they didn't hit it perfect, but we don't have many losses. So again, targets 1 and 2, absolutely perfect. These targets are just like the SST targets. It's uncanny how they can hit the exact thing by a couple pips. Catch this nice short. Had this long. Unfortunately, there's a spike right here. I don't know if you can see it. That got us in, so we did stop out of this trade. Got this short in the room. I said, okay, double bottom, look at that. So we exited for profit down here. And then we have been long since the end of December, actually really first part of January, because we didn't even really have to trade, but we had a number of days to get on board this trade. And it's been going back. Again, directional bounce, pull back right here, another one kind of right there, and it's been selling off right there. So this is, we don't just make this up looking at a chart. This is what we actually use every night. Finally, I mentioned the euro. This is a daily chart, and it goes back to November. I had more I could have shown you, but I really wanted to kind of zoom it in and blow it up for you. This was, the high that we had back in November, and obviously it was in a nice big sell-off. Hit this bottom here, 126. The reason I said if it breaks 120, I think it's on the daily chart. If it breaks 126, you can see it go all the way down to 124. But right now, just using those fibs, you can look for a good solid retracement up here to this 134 level, and then I think it's going to resume its southern trend due to just the whole euro and everything. It's rallying now, but who knows how long it will go. If for some reason it does break this 136 level, then hey, shorts are off. Start looking for some possible longs. I mean, who knows? I can't predict exactly what will happen, but so those are some good levels for you. Look for that 134, retrace, then maybe go short, and then if it does end up going below this 126 level, look for it to go back down to 124, and that's based off the daily chart, just some swings. Really, pull up a daily chart and you'll spot those without anything. So like I was saying, swing trading is for wealth generation. Day trading is, fun for, it's almost like scalping, but you can obviously make very good money day trading. But really, to get those really big trades coming in, when you start getting $10,000, $20,000 winners, that is because of swing trading. Day trades, yeah, you might make 1,000, 1,500, 500, but the big money is made for the wealth generation, and you generally need a larger size account to do that. Use sound money management. That is critical. Okay, you can blow out your account swing trading with bad money management because again, you're going for bigger trades, so you might have the propensity to, okay, it's going against me a little bit. Let me dollar, cost average. Let me buy some more. Okay, it's almost at my stop. I think it's going to turn around. Let me buy some more and move my stop. Boom, your account's going to be gone. So just please, 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 don't do that. Stops are there for a reason. If it hits it, it hits it. Move on to the next trade. Diversify. Watch for correlation. Okay, don't put all your eggs in one basket. Follow your signals and trust your system. Very, very important. Follow those signals. Make sure those stops are there, and they're there for a reason. Don't watch the trades. Let them run. I make mistakes, even the swing trading. I'll get up in the morning, I'll look at the chart, and I'll see that it got 5 pips to the full target. So I'll send out a tweet. I'll say, hey, got 5 pips to full target. You might want to sell some and then move your stop to break even. And so obviously we're locking in. We're making some good money, but then again, sometimes it's pulled back a little bit harder, taking me out at break even, and then it rolls on down to the second full target and the second target. So, just try not to watch them. Just let them do their thing. You've got targets there, but certainly if they get really close, take a little bit of action, sell some. You've got another position typically for the bigger moves. And look for some great moves this year. There were some great predictions. I thought about later doing something on the S&P. I do think the U.S. market is going to go up this year. It's going to go up probably 10-15%. And oil is going to go up. Commodities are going to go up. I think the euro will go down. And that is pretty much it. So you all, it's been great having you for 2011, and stick with us for 2012. And I think you will be very pleased with the outcome.
Thanks, Ron. Do appreciate that. So this is a portion of the presentation where you get a chance to ask some questions. So we'll let you all do that. I wanted to try to dig up my 2011 predictions because honestly I had no idea how I did, good or bad, since you guys were brave enough to show your last year predictions. So I tried to dig up my slide from last year. And if you do have questions, go ahead and put those in, and I'll jump over to those, and myself or the other coaches will answer. So looking at last year, I mean, I did all right. I mean, we could argue, did 2011 continue the market bull? I don't know. I mean, it was break even to slightly higher, so that's questionable. Unemployment definitely peaked. Housing did find some stability. I don't know if we would say IPOs were back in a big way. There were some. But obviously, I think 2012 will have the bigger ones, such as obviously Facebook. We had some interesting ones in 2011. Corporate earnings, probably like Bob pointed out, that was probably wrong. They probably really hadn't peaked. They actually even improved in 2011. And then, of course, the whole Android versus iPhone. I really felt that would drive a lot of what was happening in the tech sector. And I guess arguably to some degree that's been the case. Probably my worst prediction of all was this one. Once again, that's just a dumb prediction overall. So that just goes to show you. But with that, let's go ahead and look at some questions here. So let me open up the panel and see what we got. One thing that I wanted to mention when Ron was sort of talking is that he does real well, and just understand, we do a lot of sort of mechanical-based, rule-based systems, and especially on swing trading, he always looks at the broader context of what's happening, and even if something doesn't quite meet his full initial mechanical objective, he'll make adjustments and really take what the market will give him, and I think that's probably a good lesson in there. I know that's something that we try to do. A lot of times it frustrates people because they want everything to be 100% mechanical, but unfortunately the market just doesn't really listen to what we want. So that was just something as he was talking that I thought of. So some questions here. Steve's asking, has the MF Global issue changed the way you are investing? Should we be concerned about accounts with, say, TradeStation or Ninja? Well, Ninja's not really a broker, so they're not going to hold any of your funds. I don't know. Any of the coaches have an opinion on fund safety, or did MF Global change the way you thought about where your account was?
This is Bob. I can speak to that.
Go ahead.
Oh, okay. No, it really didn't. I, like everybody else, probably shuddered a little bit and did a little investigating to find out, gee, am I at risk of that? The bottom line is all the top brokerage firms, and you should all be trading with a top brokerage firm, not some fly-by-night thing, but all the top ones, you know there's your money separated from their trading side, but they don't trade. They're just straight brokerage firms. The problem with MF Global was that they had a trading side and the account side. And for your typical Schwab, TD Ameritrade, you think of Swim, your TradeStation, any of these, Trade Monster, what have you, they really are there to service their clients and their clients' brokerage needs, and their money is not at risk. So there's no real danger there. I also looked at the insurance situation with federal government insuring up to so many. I think it's I'm not sure where it is, a couple $100,000 per account, and considered moving money around to different accounts to alleviate that potential risk. But then again, I looked a little deeper and found there's really no credible risk for a trader's account in a typical mainstream brokerage account. I don't know if any of the coaches have looked into it as well, but those are my findings.
Great, thank you. Any other coach? I don't know, want to weigh on that at all? Okay, so let's move on. Question from Hamid. It's which platform do you or should I use for trading Forex, oil, gold, using NetPicks strategies and systems, NinjaTrader, or MT4? I mean, to me, if you're trading futures, you can exclude MetaTrader 4. So typically, our answer would be TradeStation or NinjaTrader, since you can chart Forex, oil, gold, futures, Forex, stock, options. If you're trying to do Forex only, then certainly you can stay with MetaTrader. I think when you want to open yourself up to things outside of Forex, you do need to go to one of the more universal platforms, so TS or NT. Alan's asking, when is the market volume going to pick up? It's barely a pulse lately, so I don't know, even Will, if you want to grab that one, since you talked the most about the volumes being so low recently.
Yeah, I have no idea is the answer. I think we're going to see, whenever we see some nice breakouts on strength, we may be forming a new trend and getting some volume back, but there's no way to predict that.
Sure. I agree with Will. I think the volume's going to pick up, though, when the stock market starts going down.
Yeah, that's probably a definite safe bet on that. One thing, if you notice when TJ was showing his charts, It's even always been an expectation of me too early on. I always expected, the day after New Year's for the markets to go right back to normal and be crazy volatile and a lot of fun. And I've noticed definitely in recent years that's about the last thing that happens, in particular the first few weeks of January are just about as dull as the last few weeks of December, I think usually until we get to earnings season. So if I was going to guess, it would become Feb 1, those bars will start to tick up, but that's my guess. Let me see what else we've got here. Just reading through a few things. Scott was asking, Ron, so are you live? Oh yeah, so what Ron was showing you was he was discussing, I think, Ron, right, your UST VIP, those are the swing trades that you cover in there, is that correct?
Yeah, that's correct. Basically, for the last, year and a half or so, I've been, I call a live swing trade room about 5 o'clock New York time in the evening. Just a quick update on about, 10, 12 pairs that I trade. And, so you can kind of come and listen live or you just see the trades and stuff like that. And I think Mark mentioned, about a copier service. We're adding that to that type service. So, but not a lot of people are on MetaTrader 4, and so they can't, do the oil or they can't chart, because I do tick charts. It's a 987 tick. Extremely good. I've done, in fact, I'm going to post another video on the UST site. I've done several month reviews of it. It's just so reliable. There was a short this morning, right down to target exactly, 45-cent short. It's just pretty much you can trade it 24 hours a day. But yeah, that's just one of the things that I do for NetPicks, and it's been very successful. I mean, a year and a half. The people that are in the room, they really enjoy it.
Another question there, Ron, for you real quick. What time frame should we use for the U.S. franc? I think you were showing 4 hours, is that correct?
Yeah, the Swissy is, I actually look on the 30-minute, the 1 hour, and the 4 hour. And I do that. The 4 hour is just, I will always take a trade off the 4 hour. But sometimes the 4 hours, already in a trend and I can't quite get in it, I can catch those reversals. Like if I pulled up the 1 hour chart, that short on the Swissy, that 1 hour caught it perfectly to the 1x and the 2x. So a lot of times, I'll kind of look and see if I can catch a move earlier on a shorter time frame, I will do that.
Great, thank you. Let me see here. Well, there's a couple questions on, which trade system to use, etc. Keltner bells versus SST. I just think we're comparing apples to oranges there. Obviously, if you're at all thinking day trading, then it's all about the SST. You cannot day trade with the Keltner bells. If you're strictly thinking Forex swing trading, then your answer is the Keltner bells and that. So that's probably the best answer, really. It depends on what you want to trade. A lot of people trade both or both styles, like a lot of us, so then it may be a combination of the two. And when I say combination, I never mean to mix signals, of course, but using both strategies. Many successful traders use multiple strategies in what they do, just to obviously have the smoothest possible equity curve. Question from Phil, what time frame do you use for crude oil? So I'm going to answer first, but I know a lot of us mentioned that, so we're going to get probably very different answers. But for me personally, I always use what I call dynamic range bars. So I'm using range bars, but I don't always use a fixed range bar. Like back in November, December, it was more in the 10-cent range. Right now it's more 8 cents or maybe 9 because the volatility, like Will was showing and even TJ, has decreased. And I think that was mentioned by a couple of people where you need to adjust based upon current market activity. But I'll let some of the other coaches jump in because I know we've got some tick-based, etc.
Well, I'll chime in because I've been calling live trades on crude oil now for a year and a half with the 377 tick chart, and it's just been really steady. It just continues to do what it does, but there's a lot of good time frames. I know we have some members in the room that are using a 610 tick actually later in the session. So they'll start with a 377 and then it'll move to the 610 later in the session, and that's been a pretty reliable time frame, although bigger. You got to really keep your risk in check. I think crude oil moves so well that there are plenty of options. You know, there's some nice Renko bars too, but I'll see what everyone else has to say about that. If anyone has anything to say.
Yeah, the day trading, the 377
same thing as you said.
Is right. That's a good staple for us. We do it every day in the live room. Swing trading, I like the 987. You know, I also have looked at some share bars, still around that around that level, the 987,000, you know, tick or share, kind of, you know, looking at volume.
Yeah, and then as far as hours, I think Phil, you followed up. I think most of us would agree. 9 o'clock New York to about 10:30. We can argue, you know, what's best overall. We'll talk very much about, you know, first 30 minutes somewhere in there. But in general, the trade plans are typically that 9 to 10:30, some derivation of that, and we usually are very careful on the weekly inventory report day. If we take a trade before, it's usually one. If not, we wait until 2 minutes after the inventory report Wednesday at 10:32 usually. So anyway, hope that helps you guys. Differences between UST and Keltner Bells, probably not the best place to go into a big discussion on this, but really completely different strategies. The similarities, of course, they both swing trade Forex, right? They both swing trade some of the same markets. Keltner Bells trades some maybe more exotic pairs that the UST isn't currently, and then of course, like we're talking time intervals, Keltner Bells is only range and Renko, and UST basically is time and tick. So those are the differences there. Let's see, Daniel talking about, well, we may have, Daniel, in the case you're asking about doing some live in-person training. On occasion we do that. Actually, TJ on occasion has done it in Europe over the past year. I know he's got some plans potentially to do another live training, and we did one as part of the SST Pro in Florida about a month or so ago. So we'll have some of those opportunities, I'm sure, during 2012. I don't know on the calendar exactly when, but you know, just read the emails coming from us, and we'll keep you up to date and let you know on that. So with that, I think I'm going to go ahead and wrap it here, since we went on for a little while. We had a lot of people speaking, so we actually did really good for the number of people contributing today. So I hope you guys got some good little tips out of that. We appreciate you joining us. We're excited, definitely, about 2012. Lots of good opportunities. You can see we've got some differing opinions on where we think the year is heading, but I think we're all kind of unified and really our approaches to the markets overall. So with that, thank you to all of the coaches, and thanks to everybody else for joining us live or listening to this on a replay. So have a great trading year. Thank you, everybody.